You remember when you had a 1% income tax rate? Neither do I, but this is awesome, man. Welcome to Heritage Wealth Planning YouTube channel, my friends, the place where you can learn about tax history. I had a guy send me this right here, the income tax from form 1040 from 1913. Can you see? I don't know if you can see that or not. Right there, 1913. The income tax 1040 from 1914, a 4-pager. When I remember there's a guy named Dick Armey, who was a House Majority Leader for the Republicans, who was part of the Republican Revolution in 1994. He's a heavy chain-smoking guy, just a salt of the earth, just an old school Texan. And he was an economics professor. I can't remember where, but anyway. And he used to have this thing called the flat tax, and that's never going to go anywhere. And we'll explain why at some point, but it just never will. But anyway, this whole thing is a file on a postcard and be done with it. And I tell you, him and Phil Graham, who was another Democrat turned Republican from Texas, just a wonderful idea in terms of complexity, getting rid of the inefficiency of the tax code, regardless of what your thoughts on Republicans. Flat tax is wonderful. And, one of the biggest tax cutters was JFK. A lot of people don't realize that. JFK was one of the biggest tax cutters there were. And a lot of people think he was not. It's simply not true. But anyway, it's interesting. So here's the old 1040. And return of net income received or accrued during the years ended by December 31st, 1913. And so basically, whoever sent this to me is a veteran, I think, because he's part of the American Legion and he's has USAA. So from Michigan, thanks. All right, so I want to share this with you a little bit. Basically, it's filed by full name of individual and your street and number in the city or town. That's it. So filed by old Josh, 121 Main Street, Portland, Maine. That's it. You don't even have a zip code back then or anything. Gross income, you put your gross income, you put your general deductions and your net income. That's it. Deductions and exemptions allowed and computing income subject to the normal 1% tax rate. What is 1% tax rate? 1% on or around $20,000 and not exceeding $50,000. That is a 1% tax rate. On or around $20,000, not exceeding $50,000. So essentially, you weren't paying any tax or anything below that. 50,000 to 75,000 is a 2%, 75 to 100,000 is 3%, and is 6% on anything over $500,000. This is a 1913 year, by the way, and we're going to show you what that means today if you inflate it for today's numbers. And so basically, the penalty for failure to have this returned in the hands of the collector on or before March 1st is $20 to $1,000. That was the fee if you did not have it filed with the IRS or the collection agency by March 1st of the year. So let's talk about the general deductions. This is pretty interesting. The amount of net. So basically what you have is you have some deductions. Actually, let's talk about gross income. So they have two sheets. They divide it into gross income, and then they divide it to general deductions. So your gross income, this statement must show the proper spaces for the amount of gains, profits, and income received or accrued to the individual for all sources during the year specified. So line item 1 on your gross income, total amount derived from salaries, wages, or compensation. Number 2, total amount derived from professions, vocations, businesses, trade, including bond or stocks. Total amount. Number 3, total amount derived from rents from interest on notes, mortgages, and securities. So you loan money, and that is your taxable interest right there. Total amount. Number 4, line item 4, total amount of gains or profits derived from businesses, partnership business, whether the same be divided or distributed or not. So if you have gains, you got to put that on your gross income, line 4. Number 5, total amount of fixed and determinable annual gains, profits, and or income derived from interest upon bonds and mortgages or deeds of trust or other similar obligations, blah, blah, blah. Joint Stock Companies Association. Line item 6, total amount of income derived from coupons, checks, or bills in exchange for fee and payment of interest upon bonds being issued in foreign countries. I think, did I miss something? Total amount 7, total amount of income derived from fiduciaries. And line item 8, total amount of income derived from any source, whatever not specified above. So number 2 was actually total amount derived from professions, vocations, businesses, trade, commerce, sales, or dealings in property, whether real or business, growing out of the ownership or use of interest in real, including stocks or bonds. Okay, there you go. And then number 9, you total all those up. And then you have your number 11 is your total amount of income derived from dividends on the stock or net earnings of corporations joint. So there's your dividends. And then you take your line item 12 and you add those up as your gross income. So you got 12 lines, of which 2 are just additional of the previous ones. And that's it. Now you go over to deductions. So that's it. That's your whole adjusted gross income. Here are deductions. The amount of necessary expense actually paid in carrying on business, but not including business expenses of partnerships and not including personal living and family expenses. Number 2, all interest paid within the year on personal indebtedness. So any interest you had, you can deduct it. Number 3, all national, state, county, school, and municipal taxes paid within the year. So any taxes you paid to your localities, you got to deduct. Number 4, losses actually sustained during the year incurred in trade or arising from fires, storms, or shipwreck, not compensated by insurance. So uninsurance, if you didn't get compensated by your insurance claims, you could write that off. Number 5, debts due which have been actually ascertained to be worthless. So writing off bad debts. Number 6, amount representing a reasonable allowance for the exhaustion, wear, and tear of property arising out of its use or employment in the business, not to exceed, in the case of mines, 5% of the gross value at the time, blah, blah, blah. So basically, they're giving you a lot of leeway to say what's a reasonable amount. And of course, people abuse that reasonable amount. And so the IRS has to jump in and say, you weren't being reasonable in your use of reasonable amount. And so we're going to audit everybody, essentially. Now, not very many people get audited. That's the thing about the voluntary tax code. It's completely voluntary. You don't need to do it. You don't. I mean, the idea that if you don't do it, you're exercising your right as an American citizen. You will go to jail. But you only go to jail if you get audited. I mean, that's one of the interesting things about the tax code is still voluntary. Now, if you're one of the, it's like speeding. Everyone speeds. If you're one of the unfortunate ones get caught, well, you can't say, well, everybody else does it. Well, you got caught. It's just like the tax code. If you don't have to do it. If you're one of the unfortunate ones get caught, you will pay up. It's just a fact. Now, the likelihood of that happening, like the likelihood of you getting a speeding ticket is quite small. But that's the risk you can take for sure. And that's it. That's literally it. So you take all your income, you take your deductions, and then on top of that, you also have a $3,000, exemption here. Let's see. When the net income shown above on line 3, which is your gross income, so that, look at this. I'm going to show you line 3. This is from 1913. So your line 3 is your gross income, net income, your gross income, general deductions, net income. And it says, let's see, taxable income on which the normal 1% to be taxed. When the net income shown above on line 3 exceeds $20,000, the additional tax thereon must be calculated as per the schedule below. We just talked about. So if it's over 1% over 20,000, 2% over 50,000, so on and so on. That is pretty cool. I like that. So now let me show you something. This is pretty interesting to me. So now we go to, here's the exemption. So again, remember, if you had a $20,000 was the 1% or less on $20,000, and here's your exemptions right here. So you have basically if you're married filing jointly, you had a $4,000 exemption plus all those other deductions you could take. And so if you were above, that'd be let's say you had no deductions, you need to have $24,000 of income before your taxable income, or I say, $24,000 of income, you have 1%, would be your tax. Your highest tax bracket back then was 7%. So if you had $20,000 of income, $24,000 of income, you'd pay a 1% tax on $20,000. I mean, 1% on $20,000. Now, this right here is pretty cool. This is from the IRS personal exemptions and individual tax rates from 1913 to 2002. For some reason, I just love this stuff. I don't know why. I was just telling my wife that I'm kind of weird like that, but I love it. So anyway, here you got 3,000 single person exemptions, 4,000 married couples, 1% tax rate. Now watch what happens here. Oh, here comes World War II. All right, so now this is World War I up in here, and still the tax rates were low. Now they did go from 1% to 6%, which again shows you the cost of war. But then it went back down again. Ironically, how the tax rates went quite low after the war, and we had the booming 20s. Now we go into 1930s, and the Great Depression really kicked on around here under FDR's tutelage, and the tax rates were relatively high compared to previous days, but still it turns out incredibly low. Which just shows you that the tax rate in of itself is not you're not going to be able to ascertain prosperous economies or not prosperous economies just on the tax rate alone. You just can't. In fact, there's a guy, Hernando de Soto, not the explorer, but he writes about Peru. He calls it the other path, where he says, look, the tax rates are stifling. So they have all this underground economy that no one pays tax on. So you can have a high tax rate all day long. But if you are, you're going to just drive people underground, which is why I don't believe in prohibition, by the way, of any sort, because all you're doing is you're driving that under the ground and you're making the most violent criminal behavior rise to the top so they can eliminate their competition. Exactly what happened to the alcohol war. Same thing happens in the drug war. Same thing will happen as they make cigarettes more and more illegal. I mean, it's as surely as the sun rises in the east, when you make things prohibited and put a price on them to make them even that much more valuable, criminal elements will get there, and then innocent people will be subject to the vagaries of the criminal elements. All right. Well, anyway, so let's go to 1943. We see the exemptions start dropping from $3,000 to $500 here. Now, this is because to fund the war effort. So $500 is the exemption for single, $1,200 if you're married. But look at these tax rates. 19% was the lowest, 88% was the highest, and it dropped from $5 million to $200,000. I mean, look at that. That's the lowest $2,000 in 1944. You're paying. I mean, if you had a taxable income of $2,500, you're paying 23% on $2,000 because you got the first $500 as an exemption. I mean, that's crazy. If you had a taxable income of over $200,000, you're paying 94%. Crazy. And as you can see, the tax rates, the exemptions stayed low for a long time. In fact, if we go, I mean, you can look at this, until you're blue in the face, but you see the exemptions here. Now, this does not include the standard deductions, which you have to add on top of that. But all right, so I want to show you something here. Here's the tax foundation and how much I love the tax foundation. All right, so let's go to 1913, which is, oops, if I can get back there. Here we go. So the 1% tax rate in constant 2013 dollars, 1% on $0 to $463,000 was essentially above and beyond the $50,000 threshold, because $50,000 is where you pay 2%. All right. Now, don't forget, we're not even including the $3,000 exemption or $4,000, or $4,000 married filing jointly. We're not even including that $4,000 exemption. I don't even know what that'd be inflated till today. $80,000, something like that. So, I mean, basically, and then if you have any deductions, essentially you weren't paying any income tax if you're married, unless you had the equivalent of today of $150,000 of income or so. And that's just incredible. 1% marginal rate from zero. And that's your taxable income now. Don't forget, that's not your gross income. It's your taxable income. I talk all the time about the difference between taxable income and gross income. So you basically had to have 150,000 roughly of gross income. And once you did, you paid 1% tax. And then you're going to pay another. You don't go up the tax bracket until you have over $463,000 of taxable income. And once you go above that, you only go to 2%. Now there's a 100% increase in taxes. I love it. So it's very interesting to me. So to the man who sent me this from Michigan, man, this is great. I'm going to put this in a, like one of these plastic things here. Because I love this stuff. And it's just interesting. This is a tax foundation. I'll put the link in the show notes here where they show you all historical tax rates adjusted for inflation or not. Let's see if I can't find the page here. Yeah, U.S. Let me just move myself. U.S. Oops, let me just make this a little bit smaller. U.S. individual income tax rate history, 1862 nominal and inflation adjusted. I mean, if you're a tax junkie like I am, there's more than you'll love in this thing right here. So anyway, lastly, let's just remember too, don't forget, we didn't have Social Security. Oops, what happened here? Oops. Yeah, okay. For some reason, I came back to my Google here. We didn't have Social Security back then. All right, so we didn't have Medicare, we didn't have Social Security, and you can argue against it or for it. It frankly, doesn't matter. The facts are we did not have it, and there were a lot of poor people. And now the facts are there are less poor people. I mean, that's just all there is to it, relatively speaking, to the general world as a whole. Back then, there's a lot of poverty running around the United States, lots of poverty. And that is the thing about the safety net, the social safety net. It's not going to be a libertarian fantasy to say we need a social safety net. But the facts are, when it comes to making sure the bottom of us among us have some kind of sustenance, FDR had it. I mean, he did, and that will never be taken away. There's just too many people who rely on that too much. The taxpayer will always support those people because there's too many voters on that bottom rung. And what does that mean? For all you who say Social Security is going bankrupt, or all you saying Social Security will never be there, I would encourage you to think again. The voters who are receiving Social Security dwarf the voters who don't receive a huge amount of Social Security. And because we're the representative democracy, facts are the voters on the bottom rung will always vote in their interest to keep Social Security. That's just a fact. And so not using Social Security in your plan, I've never understood that, because that'd be ideally saying, well, Social Security might not be there. That's just it's silly. It's not going to happen. And that's, the facts are we have Medicare in here too. Now, will we have Medicare for all like Sanders wants to do? I highly suspect we won't. But we'll always have, again, the safety net. Once you have the safety net, you'll never take it away. And you may or may not agree with that. The libertarian in me says there's probably a more efficient way to do it. But I don't, my own eyes see the fact that we had poverty in mass in the United States, and now we don't have. We just don't. We don't have the same poverty today as we did back 100 years ago. Now you could attribute that to the social safety net. You could attribute that to just productivity. You can contribute to all things, but at the end of the day, the facts are the majority of Americans rely on the social safety net more so than they rely on their own savings and Medicare or their own health insurance. So because of that, it will never go away. And lastly, I just want to say Medicare, well, maybe Medicare, but Social Security is not a welfare thing. You are paying 15%, 7 of your own money, 7.5 of your employers. That money could be used to you. That is not a welfare if you're receiving Social Security. It's not. And so it drives me crazy when people say it's a welfare program. No, it's not. If you pay 7.5 on both sides of the employee, calculation there, that's 15% of whatever your income is. If you made $100,000, that's $15,000 a year. That is not going to your salary. It's going to this thing called the social safety net, Social Security. So I just think we need to stop the idea that Social Security is a welfare program. Medicare is different because you don't charge nearly enough for Medicare, and that's going to have to fix. We know that for a fact. But as we say here today, Social Security is not a welfare system. It is a fee-for-service system. I am paying many years over my work history, 35 or 40 or 50 years, whatever, and I will get back a portion of that, what I put in. That's just what it is. That is not welfare. All right. So anyway, I just thought it'd be interesting. I love the tax code. The history of it just fascinates me. So hope you like what you see here. And as always, subscribe down below. Don't forget to share the channel with others. And if you have any questions, thoughts, and concerns, just put comments down there. And of course, thumbs up always help as well. See you guys.